In 2008, a massive financial crisis hit the U.S. economy. And what's fascinating about it is that most economists could not correctly forecast it. That's why we're listening always to the legendary Warren Buffett, who always seemed to know more than others. And the 2008 situation is a prime example of that. The U.S. economy is under a pressure. Massive government debt, war with Iran, and multiple new changes in economy given artificial intelligence boom, causing divergence between job openings and the stock market. That's why we're looking at this model from the New York Fed. This model uses the gap between the 10-year and 3-month Treasury yields to estimate the chance of a U.S. recession within the next year. The sharp fall from the 2024 to 25 peaks suggests the yield curve is sending a much less alarming signal now, so recession is clearly no longer the model's main expectation. What's interesting is that the probability has not returned close to zero. The yield curve has improved, but it is not steep enough to signal an entirely normal, low-risk environment. More importantly, the model never treats recession risk as literally zero. Even after an inversion ends, restrictive interest rates and their delayed effects on borrowing and spending can continue to weigh on the economy. So this chart is essentially saying the danger has eased considerably, but the economy isn't still perfectly safe. The yield curve is the difference between interest rates on short-term and long-term government bonds. Normally, long-term bonds pay more because investors are lending their money for longer. When short-term rates rise above long-term rates, the curve inverts. That means that current monetary conditions are tight, and investors expect weaker growth and lower rates in the future. Obviously, it's not normal for the short-term rates to be higher than long-term rates. That is, in fact, an anomaly. In a healthy economy, longer-term debt pays more to compensate for uncertainty and time. Historically, the relationship has been very powerful. If you look closely at these recessions as defined by NBER, every time yield curve had inverted, a recession followed. What is fascinating, though, is that the 2022 yield curve inversion did not lead straight into recession, because the economy was still being carried by the enormous support created during the pandemic. That money kept consumer spending and allowed growth to continue, even as higher interest rates began to weaken the economy. Yep, that's the straightforward take from it. The normal economic cycle was changed synthetically by the massive post-pandemic spending. Massive fiscal and monetary stimulus led to households and companies that were able to use it as a cushion. Obviously, that caused a massive 9% inflation. However, the excess cash in the economy created a situation where GDP continued to grow, even though we believe would probably contract and cause a recession. The massive financial injections delayed or mostly canceled the potential crisis. That's why we're looking at those recession indicators in context of the entire economy. Worked multiple times before, failed in 2023. However, in that sense, the yield curve may not have failed. Its warning was simply pushed back by brutally strong policy support and excess liquidity. The chart shows that the U.S. economy is still growing, but the path has become much less comfortable. Real GDP rose about 2.1% in the first quarter of 2026, improving from only 0.5% in the previous quarter. That is not weak enough to signal an outright contraction, but the sharp movement from one quarter to another shows how uneven the economy has become. Growth is continuing, yet it is doing so under much greater pressure. An economy growing around 2% can remain stable, but it does not have much protection if spending weakens or unemployment rises, or if another shock appears. And this ought not to be confused with the stock market. Stocks can rise due to expected rate cuts or continued growth of corporate profits. While the stock market reflects expectations and financial conditions, GDP shows actual production and spending across the economy. They are connected, but they are not the same thing. And a strong stock market does not automatically mean the underlying economy is strong. Big difference. The U.S. GDP in the first quarter 2026 was about nearly $32 trillion. The GDP can actually be calculated. The formula is consumption, business investment, government spending, and net exports. Problems begin when households slow their spending or when the companies become more cautious and cut investment. And it's not exactly possible to get an image of the economy by looking at the stock market. Stock market is valued. The valuation is important. Market value is simply the price investors are willing to pay today, while true or intrinsic value depends on the profits and cash flows a company can realistically produce over time. When markets appear strong but the fundamental pillars are not there, a correction is usually ahead. That gap between intrinsic value and price can persist for a long time, but it also can accumulate further into a massive bubble over time. The efficient market hypothesis becomes dangerous when investors treat it as a law of nature. In its strongest form, it tells us that prices already reflect all available information, so a stock trading at an extreme valuation must somehow deserve it. That idea can make investors stop questioning the price. History shows that markets can be badly wrong for long periods. Dot-com stocks reached absurd prices before the 2000 and 2001 crash. Housing was treated as nearly risk-free before the financial crisis, and speculative stocks reached extreme valuations in 2021 before collapsing in 2022. During each boom, investors created convincing stories to explain why traditional valuation no longer mattered. That shows how terribly wrong the efficient market hypothesis is, and yet it is still taught at universities globally. That's why there's this amazing tool called the Buffett indicator. The Buffett indicator compares the total value of the U.S. stock market with the size of the U.S. economy. Buffett had a great idea to compare these two. The simple goal of this number is to be a simple way to judge whether stock prices had become disconnected from the economic base supporting them. The formula is total U.S. stock market value divided by annualized U.S. GDP. In this chart, the U.S. total stock market value is $69 trillion, while annualized GDP is nearly $31.5 trillion. That makes a Buffett indicator of about 219%, a very high number historically, like extremely high valuation. In plain terms, the stock market is valued at more than twice the annual output of the entire U.S. economy. This chart is also adjusted for its long-term historical trend and places the March 2026 reading about 2.1 standard deviations above that trend. As you see, we're now at similar levels the internet bubble in 2001 was. This obviously doesn't mean the Buffett indicator is forecasting a recession. Two very different things. Obviously, as you can see, during the 1950s and 60s, the markets kept rising above fundamentals, and the ratio was similarly high to today, but remained like this for decades. So this current valuation could theoretically continue further for more years. There could be another reasons the ratio may naturally sit higher today than it did decades ago. Large U.S.-listed companies earn substantial revenue overseas, while the denominator measures only U.S. GDP. Obviously, this shows us if in the denominator were some more parts of the global GDP added, then the whole number of this indicator would be smaller. A recent study shows that 41% of revenue of the S&P 500 comes from abroad. It's honestly shocking how little people are listening to this. Thanks for watching. You're here to feel good and feel well.
This is Glennaeus.